Thank you for joining us for this Growth Equity edition of the Gabelli podcast series. This is Theresa Pope from GAMCO's institutional team, and joining me is Chris Ward, Portfolio Manager for GAMCO Large Cap Growth and Gabelli Global Growth Fund Strategies. For the next 20 minutes, we'll discuss the market and where we see investment opportunities. So welcome, Chris.
Thanks, Terry. Thanks for having me.
Given all that has transpired in the world and the markets these last few months, we thought it would be great to sit down with you again and unpack what you and the growth team are seeing and how you're managing through these times. When we last spoke in July, we went pretty in depth on inflationary pressures, but we also talked about potential inflationary offsets in the intermediate term, such as supply chain bottleneck easing and stimulus fading and improving labor market participation. But that was 8 months ago. So can you provide an update on your views there?
Yeah, so clearly inflation has been much more durable and greater in magnitude than the Fed was hoping. And that is why in November you heard Fed Chair Powell retire the word transitory. And that was really one of the primary catalysts for this correction in growth stocks, as the Fed signaled their intention to accelerate the pace of tapering and rate hikes. And then the tragedy in Ukraine has further complicated the macro backdrop, and it's a little uncomfortable talking about economic impact at a time of so much human suffering. But the conflict is largely exacerbating some of the challenges that were already in place. So things like supply chain and inflation. High energy prices are obviously a concern right now, with U.S. crude over $120 a barrel. You've seen the price of nickel surge, nickel being a key component in electric vehicle batteries. One thing we are watching closely is neon gas. Neon gas is used in the lithography process of semiconductor manufacturing, and UCAN supplies about half the world's neon gas. It's important to keep in mind, however, energy prices do drive headline inflation, but we have to remember high energy prices act as a tax on the consumer by reducing their purchasing power and constraining their ability to spend on other goods and services. So higher energy prices are certainly a concern for overall GDP growth, and that brings with it its own set of challenges for cyclical parts of the economy. But for a growth investor whose stocks are very sensitive to upward inflationary pressures and interest rates, to the extent we see decelerating economic growth, that is actually a supportive backdrop for growth stocks. The worst case outcome for growth investors at this point is really all about wages, I would argue. And that's because a potential wage inflation spiral can be self-fulfilling. That's really the problem that we had in the 70s. So with regard to wage inflation, just a few important things that I would point out. So first, the labor force participation rate. We did see really strong payroll number last week with basically no change in average hourly earnings. So it does appear that labor supply is improving and consumers are returning to the workforce as stimulus benefits have now expired and as child care complications are gradually easing with COVID concerns gradually waning. And then productivity growth, which is key to maintaining unit labor costs. And productivity growth remains above pre-COVID levels as so many firms and businesses have invested in efficiency tools like automation and software. So growth stock multiples, they were being supported last year from very negative real interest rates, so nominal rates minus inflation. But that was not a sustainable dynamic, and today we are seeing real rates become less negative, and hence the unwind in growth stock multiples. But to be sure, it is deserved and overdue. But ultimately, we think it'll be an opportunity for investors with a long-term time horizon.
And I definitely want to talk about opportunities you see in a bit. But before I get to that, let's talk about technology landscape. So in our last conversations on the podcast, you talked about the broad adoption of digital technologies as a result of the pandemic. And since then, we've seen a significant correction in technology stocks, and macro obviously has been a factor, but has anything else changed fundamentally? What is your view on technology right now?
Yeah, and Terry, I remember we talked last time about the concept of duration and interest rate risk for growth stocks, and that is now playing out. And I would make a couple of comments on the tech landscape right now. First, we are getting to a point where valuation support is starting to creep back into the market. So For instance, many enterprise software stocks today are trading at multiples we haven't seen in 3 years or more, despite a 10-year yield of 1.8% today versus 3% back then. And despite, in many cases, a stronger spending environment today. So, the correction could continue, of course, but that is just one relevant data point, just for context. But to answer your question on fundamentals, we do take some comfort during this period of volatility in the fact that the vast majority of names that we own continue to beat expectations. This is not a 1999-2000 tech bubble situation where many growth companies failed to deliver on revenue or earnings expectations. Of course, there are always idiosyncratic issues out there, but generally speaking, fundamentals today for software, digital advertising, semiconductors, all very robust. One thing I think we've done a good job at over the last 2 years, and certainly haven't done a great job at everything, but I do think we've done a good job at avoiding the pandemic beneficiaries of 2020 whose business results were just not sustainable. So Peloton is one more recent example. And if I were to rewind to December 2020, our year-end webinar to clients, we cautioned against these pandemic beneficiaries. And we specifically talked about Zoom video and how such a huge portion of Zoom's revenue base was comprised at the time of these really small customers with fewer than 10 employees. And we talked about how that cohort had a really, really high churn tendency and that it was going to be a lingering issue for the top line for quite some time. And sure enough, just this last quarter, Zoom reported total customers declined quarter over quarter. Zoom's revenue growth in the quarter decelerated to 20% year over year, and they're guiding to calendar 2022 revenue growth of just 10%. So that's quite a fall from the 300% plus revenue growth numbers they were putting up in calendar 2020. And amazingly, if you look at a chart of Zoom, you will see that it has retraced all of the gains it made since March 2020. So Zoom, the single biggest beneficiary of the global pandemic, is trading at an equity value below where it was in 2019, which is just remarkable to think about when you consider how much bigger their revenue base is today and how attractive their margin profile is. And you actually hear commentators on TV point this out and argue that the market is inefficient because look at Zoom trading below its pre-pandemic market cap. But what these people are missing is that this is actually a great example of why growth rates are so important in determining trading multiples. So just as an example, if you're trying to value a stock 5 years out, it's one thing to pinpoint the revenue and margin profile, and maybe you can tell me the earnings power of a stock in 5 years. But if you can't determine the growth rate, then you really can't determine the multiple or the equity value. So this is actually a fun game to play. So I think it's worth mentioning. But you can actually make a really strong case that Zoom would be more valuable today had the pandemic never happened. So, for example, they are doing about $4 billion in run rate revenue today. Let's say there was no pandemic and instead they were doing half of that. So for simplicity's sake, not $4 billion in revenue, but $2 billion in revenue. But because of no pull forward, they were still growing, hypothetically, 45% year over year. So the average growth adjusted multiple for software right now is about 0.4, 0.5. So 45% revenue growth would command a revenue multiple of about 20 times. 20 multiplied by $2 billion of revenue would be a $40 billion equity cap in this hypothetical scenario. And today, the market cap of Zoom is just $32 billion. So again, I think it's just interesting to think through things like this, and I just point that out to show how important durability of growth is to valuation.
Let's segue into where you're finding opportunities within technology. Are you favoring names that continue to execute well, or might there be an opportunity in some of these names like Zoom who are trading at pre-pandemic levels?
Fortunately for investors, I think there are a number of stocks out there that continue to execute flawlessly, whose valuations have come way down, purely driven by macro forces. So generally speaking, I would say we are focused on upgrading the overall quality of our portfolio by leaning into some of those names and with a clear preference for free cash flow generative businesses. However, that being said, I do think this is interesting. And if we use Zoom as a as a proxy or a barometer for this category of pandemic beneficiaries. And again, these are names we've generally avoided. I do think looking forward, things are starting to get more interesting for this group of stocks. And just using Zoom as an example again, their management team is guiding to revenue acceleration in the back half of the year, driven by growth in their enterprise customers and by more stable churn rates as that pandemic cohort ages. So Zoom's stock price, if we all recall, peaked in October of 2020. This was the same quarter that their revenue growth peaked at something like 365% year over year. And ever since then, revenue growth has been decelerating, coinciding with a pretty steep fall in the stock. And so again, I just think this highlights the importance of growth rates on multiples. So now, today, you finally have visibility to a re-acceleration in revenue growth. And meanwhile, this is a handsomely profitable business with 30% free cash flow margins this past year, trades at something like 24, 25 times free cash flow. So very clear valuation support, especially if you think this business can return to 20% top line growth in a year or two. And actually, you could have made a valuation case for this stock and many others for several quarters now, especially if you can take a 3-year horizon and sort of look through some of these churn dynamics. But I think this is a perfect example of one of our investment philosophies, which is that valuation is often a poor catalyst. But today, unlike a couple of quarters ago, you do have a real inflection in the business on the horizon. So I just to reiterate, Zoom Video, not a stock we own. I think there's a question around how commodity-like unified communication platforms are. We don't necessarily have a very differentiated view on that, but it's enough of a debate to keep us away for the time being. But that being said, I do think there are a number of businesses out there today that were pandemic beneficiaries and whose business and valuation excesses have been completely washed out and can re-accelerate from here. So I do think there are a number of businesses that fit those characteristics right now.
Can we elaborate on that? You mentioned Amazon, and are there any businesses that fit those characteristics that you're finding interesting right now?
So one name we like within this context is Square, or what is now called Block. So for the uninitiated, Square, or Block as it is now known, was founded by Jack Dorsey. Dorsey, for a period of time, was splitting his time between Square and Twitter as CEO of both. Today, he is only CEO of Block. And Block has two primary businesses. So the first is its seller business, which provides hardware and software to merchants that enables them to accept payments and run their businesses. Square's heritage was in serving micro merchants, but they've since moved upmarket to larger sellers. And then there's the Cash App business. And this really originated as a P2P payments app, but has really evolved into a digital wallet super app with a much more full suite of financial services. Today, Cash App has about 44 million active users. Prior to the pandemic, the seller segment was the vast majority of Block's business, but Cash App was a major beneficiary of the pandemic, and today the two businesses generate roughly the same amount of gross profit. Though the seller remains the majority of EBITDA. Now, there was investor concern over Cash App growth going into the quarter, as it was no longer benefiting from fiscal stimulus, but lo and behold, the quarter was actually much better than feared. Cash App gross profit growth of 37% year over year. Monthly active users continue to grow healthy. And importantly, engagement remains really strong. Management called out really strong adoption of something called Cash Card, which is a Visa debit card linked to a consumer's Cash App balance. And Square earns interchange fees on those transactions. And this is considered much higher quality monetization than things like instant deposit. So Cash App, in our view, is one of only a handful of potential digital wallet super apps. I do think PayPal also has potential here with many more users than Cash App, but they've been slower innovating with super app features. You've seen Asian fintech companies like Ant Financial have become hugely successful, would have been even more successful if not for government intervention. And yes, Asian fintechs have leapfrogged the legacy payment system that is so entrenched here in the West, but I do think it is just a matter of time before digitally native younger generations in the West age up and things like digital wallets and neobanks become much more mainstream. And then the last piece to the Block thesis is the recent acquisition of Afterpay, which is a leading player in the buy now, pay later space. And that space has seen really rapid growth the last 2 years. We think Afterpay has the potential to bridge Block's merchant and Cash App businesses. And in doing so, that would create one of the really very few true-sided payment networks at scale, along with the likes of MasterCard, Visa, and PayPal. And that's a very valuable and strategic part of the payments value chain, having a direct relationship with both merchants and consumers.
And you mentioned earlier the importance of catalysts, and this is a stock where you've identified positive catalysts?
Yes, we think so. So management expects to sequentially grow gross profit each quarter across both businesses throughout this year. Cash App in particular should see its year-over-year gross profit growth rate improve in the second half of the year due to easier comps, new products, and pricing adjustments as well. So that right there is the sort of re-acceleration thesis that we think can potentially re-rate the multiple. And then you have an analyst day coming up in May of this year, and that's important. That's an important one in that we would expect management to provide updated long-term synergy targets for Afterpay and really lay out their long-term strategic vision for the integration between its consumer and merchant businesses. So that's really how we see the next 12 months unfolding.
And how are you looking at valuation for Square? This appears to be a high PE stock.
So yes, the stock is optically expensive on earnings. However, when you peel back the onion, you can see that Block actually has a very nicely profitable seller business. We estimate about 25% EBITDA margins there, still growing top line over 30%, by the way. And then separately, there's Cash App, obviously a high growth part of the business the company is investing aggressively in, not profitable yet by our estimates. So for valuation here, we do think this is a situation that justifies a sum of the parts approach. We value the seller business at 15 times EBITDA, which we think is very justified when you look across the landscape at legacy merchant acquiring businesses trading at about 12 times, but growing just high single digits. And then we value the Cash App business at 10 times gross profit, which is pretty much in line with a fintech peer group that we monitor. And just to be clear, these multiples that we are assigning today are updated for the recent D-rating in the payment space. And so taken together, we think fair value for the stock is somewhere around $175 in 2 years, and that's up from about $100 today. So that's a healthy IRR of over 30%.
Thank you all for joining us for today's growth edition of the Gabelli podcast series.
Several companies were mentioned in this episode. We own less than 1% of the following: Zoom, ticker ZM, Amazon, ticker AMZN, Peloton, ticker PTON, Block, ticker SQ, and Visa, ticker V. Following today's discussion, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of March 8th, 2022, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it will ever be held in a portfolio.